We've already mentioned that an individual investor can participate in securities trading with the help of a brokerage office. For this purpose, it is necessary to open a brokerage account. We'll discuss all the questions regarding the selection of a broker, the opening of an account, forms and agreements to be signed, etc., in a later chapter of this course. Here, though, we're going to go through the various types of accounts and types of orders. The first type of account is called a cash account. The primary feature of a cash account is that you must pay in full for any security you buy. In other words, you cannot borrow money from the brokerage. However, this does not mean that at the moment one purchases a security, they must provide the cash up front. There is a 3 business day time period during which an investor must produce this cash. This is called the settlement period. In turn, the broker is obliged to deliver the securities into an account not later than the last day of this period. The last day is called the settlement day. It's necessary to remember that this 3-day settlement period exists for common stocks, bonds, and U.S. government securities only. The settlement period for options is 1 day, and at the time of purchase, one must have the full amount in their account. In case of a failure to pay or default, your broker can liquidate your position and, as punishment, freeze the account for a certain period of time, usually 90 days. If, when the position is liquidated, there is a loss, the investor will be obliged to pay to the broker that amount. If the account has been frozen, in order to trade, one must provide enough cash up front to cover the entire cost. There is one more subtlety related to the settlement period. Let's assume you've purchased 100 shares of company XYZ stock at a price of $100 per share. According to the rules, you have 3 days to place money on your account for this purchase. However, if on the next day the price per share has risen to $105, and you sell the stock, you receive a profit of $500. Nevertheless, it is still necessary to place money in your account within the 3-day period in order to cover the initial purchase. Otherwise, you will not meet your obligations. The next type of account we're going to look at is the margin account. The margin account allows one to pay a percentage of the total cost of a purchase. The remaining balance is covered by the broker as a loan. Throughout the history of the markets, the size of the margins, thus, the market account is in fact leverage, allowing you to control twice as many assets for half the money. Accordingly, however, your risk also doubles. With a margin account, one must pay interest on the given credit, accrued interest. The interest to 2% above the established broker call loan's interest rate at that time. Now, debit balance is the amount you borrow from your brokerage on your margin account. The initial margin is the minimum capital required to purchase securities on a margin which constitutes 50% of the cost of a purchase. The margin is calculated daily and is adjusted in accordance with the current market value of the purchased security. This procedure is called marking to the market. Now let's take a look at an example. Let's say the price of XYZ stock is $60 per share. We purchase 100 shares of XYZ stock on a margin account. The initial position will look like this. Current market value of $6,000 minus the debit balance, $3,000, which is 50%. So our equity in the account will equal $3,000, or 50%. Now let's say the next day the price falls to $58. The new position will look like this. Current market value of $5,800 minus the debit balance of $3,000. Equity in the account is now $2,800. Now let's assume that sometime later, as a result of a further falling in price, the shares of XYZ have dropped to 40. The position will be current market value $4,000, debit balance $3,000, equity in the account 1,000. The question should be raised: to what level can the margin be reduced? The current rule is that it may be no less than 30% of a security's market value. The maintenance margin is the minimum allowable margin level, which is equal to 30% of the given security's market value. In our example, on the last day, there was a situation in which the equity in the account was less than the allowable maintenance margin. Such an account is considered to be under-margined. In this case, the broker will request that the client add funds to their account to bring the equity up to a level of normally 35%. A margin call is a request from a broker for a client to add capital to their account. There's another important point. Even after the investor adds enough cash to bring their margin up to 35%, the account will still have some limitations imposed on it. Such an account is referred to as a restricted account. This means that the investor will not be able to do anything that would diminish the balance, such as buying additional securities or withdrawing cash. A restricted account exists when the equity is between 30 to 50% of the current market value of the purchased assets. Naturally, a difficulty associated with margin calls occurs when the price of the purchased security moves in a direction adverse to the investor's position. If all goes as planned, then the investor makes what is called an unrealized gain in the form of funds in the account which exceed the margin required. In this case, we say that the account is over-margined. This gain is reflected in a special memorandum account, or SMA. The size of the SMA is calculated using the following formula: equity minus current market value times the size of the initial margin. Let's return to our example. Assuming that the day after we purchase shares of XYZ stock, its price increases to $65 per share. Our position will appear like this: current market value of $6,500 minus the debit balance, giving us a margin of $3,500. The SMA will equal $250. Therefore, the amount credited to the SMA equals this amount. The investor has two choices regarding what to do with the SMA balance. 1. Make a withdrawal from the account. Or 2. Use the cash to purchase new shares. Now we're going to look at margin requirements for short stock sales and naked options writing. Besides the regular margin requirements we've just discussed, there are two other operations which require special handling: short stock sales and naked options writing. The first point to be understood about both of these operations is that they can only be carried out through a margin account. The initial margin for a short stock sale is 150% of the current market value of the security plus commissions. The maintenance margin is 135%. Now what does this mean? Well, when you sell short, your account is credited in an amount equal to the current market value of the stock, 100%. Then you must add an additional 50% of the stock's price, bringing the total of the initial margin to 150%. When writing naked options, the initial margin requirement is calculated a bit differently. There are two calculations used to determine the margin required, of which the one with the higher value is applied. Now these are the formulas. P equals the options premium multiplied by the size of the contract. VU equals current market price of the underlying asset multiplied by the size of the contract. And delta ITM equals the extent to which the option is in the money. For a call option, this amount constitutes the difference between the strike and the underlying asset's price, multiplied by the size of the contract. For a put option, This amount constitutes the difference between the underlying asset's price and the strike price multiplied by the size of the contract. Now here's an example. The calculation of the initial margin for writing a call option. We have the premium of a January call 93 at $4, and the current price of XYZ stock, the underlying asset, is at $90. Bear in mind that the size of an option contract issued on common stock is 100. So we apply our two formulas. As you can see, the amount calculated in the first formula is greater than that of the second. Therefore, the first is used as the margin requirement. After you write an option, your account is credited with the premium. To figure out the amount of additional funds needed to be deposited to the account, you simply deduct the premium credited from the total of the initial margin. Now let's look at the calculation of the initial margin for writing a put option. The premium of a January put 86 is at $5, and the current price of XYZ stock, the underlying asset, is at 90. We apply our two formulas. Therefore, the initial margin should be $1,900.